The big unknown, which no one really has a good answer to, is how costly it will be to run these models in the future. What is clear is that demand is going to be very, very high, and it's going to be an exponentially higher number than it is today.
One of our recent guests on the show said, "You can't talk about AI without talking about energy." Well, it turns out the inverse of that is also true. The AI boom is driving the largest energy infrastructure build-out in a generation. It has the potential to drastically reorder society, reshaping everything from capital markets to industrial policy. And beyond the headlines about breakthrough models and billion-dollar valuations lies an even bigger challenge: building the infrastructure to support an AI-powered economy. Utilities are racing to add generation and expand transmission. Investors are pouring hundreds of billions into energy and digital infrastructure. And policymakers are grappling with difficult questions around permitting, reliability, and America's position in the global AI race. But the real economic transformation will come when AI begins to fundamentally change how businesses operate. Services are a dramatically larger market than software. If AI reshapes those industries, the scale of change will be unlike anything we've seen before. But how that happens is still a question mark.
What is not clear is what is the infrastructure amount needed as the models get more efficient. And I think anyone who says they have a strong opinion there is guessing.
This is Critical Capital. I'm Alfred Johnson, the CEO of Crux, the capital platform for the clean economy. My guest today is Jake Saper, a partner at Emergence Capital. Jake is a leading AI and software investor who's gone deep on energy. He believes we're still in the earliest stages of enterprise AI adoption. And he argues that the greatest opportunities won't come from retrofitting AI into existing operations. The best opportunities will come from building entirely new AI-native companies. Jake coined the term AI native services, or AINS, in 2024, when he first argued that AI would fundamentally reshape professional services. We'll talk about that, what it means for energy infrastructure, and how he sees the rapidly evolving AI landscape. Jake Saper, welcome to Critical Capital.
I am so thrilled to be here, Alfred. It just brings me so much joy.
It is the best to have you here. I have been looking forward to this conversation since I asked you to do it. That is in part because you are one of my closest friends. It is also in part because I think you are a rare person to talk to at this moment, because you have been a prolific SaaS investor. You are one of the leading voices on this emerging category of AI native services, which we're going to talk a lot about. And you started your career in energy and power, working in solar in India. Let's set the scene there. So I remember a story you tell of going over one of the solar fields in a hot air balloon that led to your drone deploy investment. How did that happen?
Yeah, okay. So Emergence, has the thesis behind the firm is that we want to be early experts in emerging business models, hence the name Emergence. It's founded in 2003. The business model then that was emerging was SaaS. The first investment was Salesforce. We did a lot of great early investing in horizontal SaaS. The next big wave was vertical SaaS, building SaaS specific to industries. The biggest hit that Emergence had, and actually the largest vertical software company today still, is Veeva in the pharmaceutical space. So naturally, when I joined in that era, I said, I know a lot about natural resources. So I'm going to develop a thesis around the natural resources cloud. So that is cloud software in agriculture, energy, water, et cetera. One of the very first investments that we made behind that thesis was a company called Drone Deploy, which was aiming to do drone software that would allow energy workers, construction workers, farmers to fly drones autonomously, gather a bunch of data, and make decisions. This was in contrast to what was popular at the time, which was actually investing in drone companies. But this was just a drone software play. Part of what gave us the conviction to make that investment was, it was very early. They had talked about solar as a potential category. And to your point, when I was a developer, I had to get aerial imagery of my projects, both early on to scout the land, but also to prove to the banks that it was done. So in Western India, in the Thar deserts in Rajasthan, it's really hard to get aerial imagery. So I ended up hiring a hot air balloonist who dragged his hot air balloon to the middle of the desert and launched it and took a bunch of pictures. And it was expensive, even though it was India, because it was just such a hassle to do.
Novel use case.
It was a novel use case.
Yeah.
So anyway, fast forward to my job as an investor, and they're like, hey, could we use drones to do solar stuff? And I'm like, yes. I definitely know the answer is yes. And you fast forward, whatever, a decade since we made the investment, and solar and energy is actually one of the largest categories for drone deploy. It's now the largest software provider to drones in the world. Very first board I joined. So I'm like very grateful to that experience, and it's been cool to see it happen.
All right. So now we're sitting at the present, and everything is energy and compute. We have come from this moment where you had to be squinty in order to see value creation and impact in clean energy to the largest physical infrastructure build out in human history happening to serve hungry data centers. How are you seeing the coincidence of energy and software investing today? Where do you think that there are exciting opportunities and not?
We made a decision 3 years ago, like 2023, when like shortly after GPT 3.5, that this open source model ecosystem was going to become a dominant way in which AI gets delivered. And so what that basically means is that enterprises are ultimately going to opt in large part to use open source models because they will be cheaper, they will preserve more data privacy, and they will ultimately be more customizable, and enterprises will want that. So we went big into a few companies, but one in particular called Together AI, which is a provider of inference and training services for open source models, which is a heavy user of compute and data centers and have gone deeper into the data center stack over time. That has played out well. We did the Series A there. They had a couple million in revenue. They just closed a series, I don't know what it is, and they're over $1 billion in revenue 3 years later. I also like Base 10, which is another player in the space, so I'm a big fan of that one too. What's interesting is like that Together investment was originally sort of a software investment, right? In the sense that we were using software to optimize training and inference for open source models. What it has become is an infrastructure investment, infrastructure moving from software infrastructure actually to physical infrastructure. And so there's a blurring of the worlds at this point.
Yeah, there is this really interesting other blurring, which is what will the ultimate adoption by the enterprise be? So a lot of people have quoted Benioff saying that he spent some huge amount of money on AI last year, but it's a small fraction of what he pays software engineers. And there's this question of how far into enterprise adoption are we? Are we on the doorstep, or are we, coming well up the curve? What's your sense on that as it then flows back into the question of how much compute we actually need?
I think we are not even on the doorstep. I mean, what's interesting is like Demis uses this concept of like I like this term, the foothills of the singularity, which I think is kind of like a beautiful and also very ominous phrase. I'm not smart enough to comment on whether or not the singularity is nigh. What I can say is that I think we're in the foothills of enterprise deployment, meaning I think that we are so early. And I know, because like I see what traffic goes through Base 10 and Together. I know kind of the types of companies that are using this and what types of companies are starting to experiment with it, et cetera. And we're still very early days, particularly for the larger kind of more traditional enterprises, non-tech forward ones. What I'd say is that like the vast majority of dollars in AI have gone into developing these models. There's been obviously a shift over the past 12 to 18 months in towards building the infrastructure to actually, run those models. But there's a third bucket of capital that is paltry relative to where it needs to go, which is deploying this technology across our country. And I think this is the thing that we in Silicon Valley miss, right? I think a lot of people here that never leave this like 10-mile radius and take Waymos everywhere think that like once AI hits AGI, first of all, they think it's going to be like a binary thing, which I don't believe. But they think like there's going to be a moment and then this is just going to spread across like the speed of light and everything is going to change. The real world is not that way. It's going to take a lot longer to deploy this stuff. 80% of American economy is a services-driven economy. And so until we find a way to get AI into our services businesses, this stuff is going to take a while to deploy. And so the amount of capital needed, and to your point, the amount of compute needed is still infinitesimally low relative to the ultimate need.
Do you think we'll look at hyperscalers spending $750 billion or whatever on CapEx this year in a few years and think it looks small?
Yeah, I think it's very possible. The big unknown, which like no one really has a good answer to, is how costly it will be to run these models in the future. What is clear is that demand for tokens is going to be very, very high and is going to be an exponentially higher number than it is today. What is not clear is what is the infrastructure amount needed to deliver those tokens over time as the models get more efficient. And I think anyone who says they have a strong opinion there is guessing.
Yep. Okay, so let's talk about services. Much larger part of the economy than software. I was at your recent AI Native Services Summit in San Francisco, which was awesome. You threw up a chart of just how much larger the services spend in the economy is than the software market. That has led you to a thesis on AI native services. What are AI native services definitionally?
I made that term up, so it's admittedly not a well understood or well known thing. The way, very simply, I think about how you define it is an AI native service is any service that can be delivered using AI and is faster, better, and or cheaper than the incumbent service. So that could be an AI native accounting firm, an AI native law firm, an AI native insurance brokerage, an AI native investment bank. These are all examples of services across our economy that are today powered by labor. And my thesis is that you will be able to use AI to power a significant majority portion of that job to be done. And that for many of them, there will still be a highly paid, highly valued human who sits on top of that AI and checks it and provides their stamp of approval from their experience to say, yes, I bless this, and give it on to the customer and complete the outcome.
So some investors have been focused on roll-ups, that is, buying and merging existing companies, whereas you've been focused on new builds, companies starting from scratch. Why new builds versus roll-ups?
I think they're going to work better, I guess is the TLDR. Like ultimately, I think that the attractiveness of the roll-up is, okay, I've already got distribution. I can just buy a bunch of, existing accounting firms, slam them together, and then throw AI on top. And then I've got distribution, I've got AI, I'll have a great business. I think that too ignores the realities of humanity, which is that behavior change is really, really hard. Roll-ups in general are hard. Trying to make a bunch of cultures come together and work efficiently together has always been hard. The idea that you would then develop some magical AI platform and convince the people that you don't fire, change the way they do the job, they've always done the job, to do it with AI and work in this kind of conglomerate, I think it's just really, really hard. I think it's much, much easier, although still exceedingly difficult, to start from scratch and say, I'm going to build an accounting firm. I'm going to build the GL from scratch using AI, and I'll build that GL for whatever use case I'm going to be focused on. And then I'm going to build agents that work specifically with that GL. I'm going to try it with a few small customers. I'm going to do it myself as the lead. And then as it starts to scale, I'm going to start hiring really impressive senior accountants to sit on top of this thing and train it, and ensure it's good, ensure the outcomes are really good, and then kind of scale, that way from an organic perspective. The thing that people don't understand about AI native services is that for the best versions of AI native services, you generally aren't demand constrained. Because if you're selling an existing service faster, better, and or cheaper than the incumbent, everyone's going to want to try you. So the question isn't, can you sell a lot? The question is, can you deliver this in, primarily with AI in a high quality way? And that is the biggest trap for AINS today.
Yeah, that totally makes sense and resonates with what we see. If you're rolling up a bunch of accounting firms, you need to deal with the existing service providers, the people that are already in place, the general ledgers of those firms or record systems. So give an example of a company that you think is able to be significantly better, faster, cheaper using AI as a new build versus what incumbents are able to do. And what does that look like?
So to push on the accounting analogy a little bit, we invested in a company called Hanover Park. And what Hanover Park is a fund administrator. A fund administrator is an accountant focused on private equity firms. So private equity has their own kind of bespoke accounting, and obviously fund flows is critical to this business. So there are very large existing services businesses called fund admin that serve private equity and venture capital firms to do all of that work, to do capital calls, distributions, accounting, all that stuff. Historically, these have all been powered by, people and very legacy old software that's often sold by another firm and then used by the services firm that you're contracted with, you as the venture fund of the private equity firm. Hanover built a GL from scratch that's specific to their use case to private equity. They built these agents that talk to it. And they now serve private equity firms with a service that is much faster and much higher quality than the legacy providers. So to give you an example of what that means, if you wanted to do a distribution of a public stock, for example, the way that's done today, if you have a services, legacy kind of labor-based services firm for a fund admin, is, first of all, the partners have a discussion and say, okay, I want to sell, X number of shares of Salesforce. You then have someone on your accounting team email your fund admin. The fund admin then works through a bunch of Excel files to figure out, okay, which LP owns what, and how do I figure out the right sale process, and which bank do I contact, and what are the emails I need to send to the LPs once we actually do distribution, and then someone queues up all these emails. It's a process that can take days, if not weeks, to actually get done. But I wanted to sell Salesforce today. And if I have to wait a week, that's bad.
This is not investment advice.
It's not investment advice. Yeah.
It's not purely anecdotal.
Yeah. I just pulled Salesforce, out of random. But the broader point is that's an example of where a faster service done by AI has real dollar value attached to it. And so unsurprisingly, lots of private equity firms want to buy this And so our challenge at Hanover Park is not sales. It's not just, it would make no sense for us to buy another fund admin because we don't need that distribution.
How do you think about that trade-off? When you're building an AI native services company, you have to build the company, and the company has to be better at doing the thing and or faster or cheaper. And you have to figure out how you're going to redesign the business process. And ultimately, there's this trade-off between revenue today, right? Like Hanover Park go out and sell this until the cows come home. But then they would be putting less resources on innovation and actually making the services better. How do you think about that trade-off?
It's messy. The biggest risk in AI native services is what I call mirage product market fit. And what that means is you sell a bunch of your stuff and your customers could even be happy with the service you're providing. But to perform that service, you've had to hire a bunch of people. You're not actually an AI native service. You're just a service that took the wrong form of capital. So you need to find a way to have AI platform do it, even if it means growing more slowly. So some of the best AI native services businesses, including Hanover Park, intentionally stop selling periodically so that the delivery capability and the AI platform can catch up to ensure that it is able to do 80 to 90% of the work and not people, which is a really hard muscle for a CEO to build. Like, it's crazy to think you would say, no, I'm going to stop selling. But the best ones are doing that.
Yeah, I mean, there is this other interesting trade-off there of when you have something like that, right? Like they have a better product. Presumably others will come and try to do the same thing. So there is this like competitive pressure that you have to go as quickly as possible. And there is benefit to having more reps, right? Like the more throughput you can put through the system, the more data you can acquire, the better the system can be. Again, like how do you think about when you're telling a company to go slower in order to build better, what are the things that you're looking to see them do?
Just like all things in venture and in life, it depends on the situation. There are some businesses that are in highly competitive industries where like everyone is kind of nipping at your heels. Contract law, for example. There are now a number of contract, law focused AI native services firms. And so there's a bit of a market grab for that. Something like fund admin is a little more obscure. Also, like building the GL from scratch is really, really, really hard because you have to be like a software company and you have to be a services company. The thing I often say about AINS businesses is that they're way, way harder to build than software companies because you have to build Stripe and McKinsey at the same time and have them integrate seamlessly. That is really hard to do.
So let's talk about legal for a second. You just used the example of contract law. So there are a number of these new law firms that are established to be AI in the first instance. And I think it's a good example of a category. It's a category you know well. You were on the board of Ironclad. And we see every day in our transactions, there's an enormous amount of legal work that needs to be performed around the transactions. And we're seeing increasing adoption of applications by the law firms that isn't yet really flowing through into client value or lower costs. Tell me how you see that category as a AINS category.
The last point you made is the promise for these contract-focused AINS law firms, right? The idea is like, look, we're going to cut the crap. It's not like Harvey sells to Kirkland & Ellis and then Kirkland & Ellis figures out how to use that more efficiently, but you never actually see the benefits in terms of fees or speed. We're going to do it all. We're going to take on the burden of figuring out the AI, and we're going to use that to do the contracting faster and cheaper than the legacy provider. And we're probably going to evolve the business model. Instead of charging per hour, maybe we just charge per contract, which is disruptive, obviously.
I've been really interested in this theme recently because there was this phase in early AI, like post GPT 3.5, where a bunch of the applications were doing a lot of post-training, right? And putting a ton of resources in. And in categories like legal, that was good for a minute. And then Claude came out with a better legal model. And then it looked like all that post-training wasn't worth it. I'm tracking in financial services, Bridgewater has this paper out this past week where they show that with an open source model that they did post-training on, they were able to achieve dramatically better results at much lower costs. So it seems like there is a little bit of this rotation back to wanting to own the control of the model. What do you think that looks like as the models continue to get better and people get more sophisticated in their use of the tools?
So I think there's three things that are driving that. The first is like there's a little bit of a hangover around the like token maxing spring that we all experienced.
Those were heady times.
They were heady times. And it was a solid, 6 weeks that lasted. But I think there's still a little bit of like a whoa, that was crazy talk. Like, how do we actually get value out of this stuff? Which pushed people to double click on open source models at the same time that the models just got even better. And I think that enterprises, specifically tech forward ones, have gotten smarter about how to track data to build evals. In the beginning of this Gen AI rush, people were like, yeah, I have a bunch of proprietary data, but no one actually knew which data was valuable and how to actually use it to properly post-train something. Fast forward 3 years, the core open source model you're post-training has gotten way, way better. And you have probably done a better job of collecting the eval data you need to actually post-train these things in an efficient way.
Cost is a really interesting thing for AINS companies versus the applications. As an application, you're constantly having to figure out how to moderate your compute spend. But in AINS, you're typically operating in high gross margin transactions. And so it's more about how do you make the deal process better for the counterparties than it is how do you minimize the token cost associated to it. How do you coach your AINS companies around that question?
I don't think it's always true that the AINS businesses are operating in high gross margin environments, because like often the service that they're displacing is a 10, 20, 30% gross margin business. So they've got to figure out how to do it. Mostly with AI, they're still going to have some people cost on top of it. So we still have to be mindful of gross margin. We're not in like a free lunch type of world. And obviously the tokens are replacing the labor. So if the tokens are equivalent cost to the labor, then you're not getting any alpha. So you got to find a way to have tokens be efficient. I actually think that a tailwind for AINS businesses is like a core competency they have to figure out is, how do I be as efficient as I can with model routing and my own token consumption? And so I think part of the reason why enterprises are going to want to outsource more and more stuff to an AINS business is they're not going to want to be the ones who have to stay on top of all of the latest open source machinations and how do I train this and whatever. Part of the value you're going to pay to a third party firm is for them to deal with that headache.
Yeah, it's something that we're thinking a lot about because the transactions that we operate in are very high gross margin. And so at any moment, I would trade quality and speed for cost. At the same time, when I see something like the Bridgewater thing come out and it's dramatically better, there's this question of, can you get to much better outcomes with more model control? Or can you just ride the wave of the foundation models getting better and better at different things, and you build better routing for different things that you're doing within the service? And that then leads you to a different conclusion of the way that you're setting up the underlying stack?
To me, it's an and. I don't think it's necessarily an or. Like, I think you're relying on the frontier labs to push forward the frontier by definition. That's what their name suggests they will do. And your job is to figure out what are the tasks in this transaction that need that type of juice, and which ones can do my, fine-tuned thing, and which ones can just use this super cheap open source, like off-the-shelf thing that's basically free to run. Part of your value as the AINS provider here is to make that decision so your client doesn't have to.
What other categories do you love? What do you think are the particularly high value AINS categories?
Yeah, so we've done a lot in insurance. I think we continue. We'll do stuff in insurance because it's a space that obviously very high value, very high human labor, high data. So those are all places. The other thing that's nice about it is it's generally recurring transactions in insurance. And so that's another thing that makes it interesting, I think, as a place to play. One other flag that's interesting, that's a little counterintuitive, is I tend to bias towards liking categories that should have a human in the loop indefinitely, which seems counterintuitive because why do you want isn't the whole point of this to get rid of the human and have infinite gross margin? The risk obviously is if you're in a service that truly can be provided exclusively by AI and there really is no need for a human for judgment, for cover your ass, for throat to choke, for whatever, then ultimately maybe the frontier labs will just do it and you'll be out of business. Part of why I like the AINS model is that by keeping the human in the loop, by keeping the liability, you are taking that on. That's part of the value that you're delivering as the vendor, and I think that gives you a little bit more of an enduring position. So there's some businesses where regulatorily you need a human loop. So one business I have not invested in but I'm curious about is customs brokerage. Customs brokerage is super paper heavy. It's always changing, right? Because Trump's constantly changing the tariffs, and it's done by these very highly credentialed people that have to go through this crazy intense licensing process. And so it makes sense to hire a few of those people, have them train a big model, and then sit on top of the model and deliver the service.
So let's make the transition into thinking again about what the impacts will be to the world that we live in. If all these things that we are foreseeing to be true come true, right? The enterprise adopts AI in huge numbers. We see a lot of people that had a certain kind of job no longer be necessary in that job. Entry-level work becomes a lot harder. What do you think becomes true about society and the way that we need to operate?
It's a question for a long hike.
Yeah, let's do that too.
I feel nervous about it. I am concerned that we are veering between extremes as a society and politically, and I'm concerned that our ability to manage all this AI stuff will get caught in those extremes. Because the reality is like AI is not evil, nor should we have a world that AI is unregulated. I do think that like this has become so unpopular that we have to figure out a way to address it. What's interesting is like the reasons why AI is unpopular is kind of all over the map. Like part of it is electricity pricing, which I think is imminently addressable, by the way. Like I think there are things we can do. We can make the grid more flexible. We can make it cheaper to build. Like there's things that we can do that actually should help in most cases have data centers lower energy prices versus raise energy prices. I also think that like we as an industry have done a piss poor job of explaining the benefits of AI to the end consumer, besides the vague promise of curing cancer someday, but that's not enough. Like until it cures cancer, we need to be clear about the things it's actually doing that are beneficial.
I think it's going to be really hard to get those politics back into a good place because, even let's imagine that they do that. Like substantially, the hyperscalers bring their power to the grids and, it's to the benefit of consumers. I still think there's so many structural factors that are pushing up electricity prices, right? Like we just don't have enough power for all of the stuff, for air conditioners in Texas and EVs and, AI data centers as the least of them, right? Like, and that then creates this reality where electricity prices are just going to go up. And AI is like a very obvious boogeyman on that, as opposed to like your air conditioner, which you probably like.
I think that's probably true. I think you're right that like this pinch point would probably happen regardless. I think that like there is a version of future, and this is probably a Pollyanna too rosy version of the future, but there's a version of the future where we use this moment and say like, we're going to use the build out of AI to try to support the communities they're building in and try to be as mindful as we can about energy price increases and, try to find cheaper ways to build and provide power, all those things. And it could be like a convening, coming together moment. What's not clear to me is like, when you're arguing for like a logical, non-screamy policy, it's like kind of a centristy thing, and centristy things are kind of out right now. So I'm worried about that.
I think there's something on the positive side. I think regulation is hard. I think we have just gone through this era of big industrial policy, right? The infrastructure law, the Inflation Reduction Act. And then we have all of these exogenous forces. We have increasing geopolitical competition with China. We have rising electricity prices. We have the growing awareness that we need domestic supply chains of components and materials. So I actually think there's a pretty good case for more industrial policy to support the energy manufacturing complex. I think that will probably happen. The hard thing is how you actually put in place the safeguards against true risk. Right? Like if we think that things like Mythos are just the beginning of what could represent a massive cyber threat globally, then like we haven't seen shit yet.
But to your point, your earlier point, maybe we just need that to happen. Like maybe there needs to be some, terrible thing that happens with a Mythos-like product. And that is the catalytic moment where there's some public-private consortium that says, no more, no mas, we're going to fix this.
Yeah. What's your take on the robot apocalypse?
I'm less fearful of the robot apocalypse. I invested in a company called Bedrock Robotics, which is doing self-driving excavators and dump trucks and all sorts of construction equipment. And unsurprisingly, they have a lot of work with data centers and build out of big physical infrastructure. When that works at scale, like we should be able to build data centers faster and cheaper, which ultimately, hopefully, will translate into cheaper power costs and everything. So, like, I am more of a bull that like thinks that this will ultimately be beneficial. There are absolutely questions around the labor impacts of these types of things. But what's interesting is like you have to be more granular than that and not be ham-fisted. Like in the case of excavator drivers, for example, there's a huge labor shortage, and frankly, the immigration crackdown has driven that shortage to be even higher and more extreme. So like there's a lot of robots that have to be deployed before it actually impacts like people's, current people who are working. That being said, like there's going to be transitions. Like my own view on this has changed a little bit over time, which is the most successful possible scenario for AI, I think, in our society is a medium deployment pace, right? If it goes too slow and we're outpaced by China and others where it, is unfettered, that's not good. If it goes too fast and the societal changes required by massive unemployment that happens very quickly, that's also really scary and bad. So you almost want this world of like the natural friction of our economy will prevent it from being rolled out too quickly, but not, quickly enough, hopefully, and people have time to retrain and reskill and what have you. You can hope for that scenario. You got to plan for the tails. My fear is that we don't have enough people that are planning for those tails.
Does the current pace feel medium to you? What does it feel like to you?
I think the current pace of deployment feels medium, if not slow. Like what's interesting is like, if you leave your little tech bubble and you ask people, like, first of all, no one knows what Anthropic is. Like if you ask your friends, like ask your mom, and maybe your mom will know, but like most people aren't going to know. Like, and then, I tell people that I take a robot every day to work, and they like don't believe me. When I am, outside of a major city in America, like there's just disbelief that that's true. So like it's just, and certainly you leave the country, right? And like it's abundantly clear that none of that stuff is deployed. So that it kind of dovetails my earlier point, which is like, we're so obsessed with building this technology, we have not given as much thought or resources to the deployment of the technology throughout our economy and world. And I'm glad in some ways that like the deployment, I think, will not be instantaneous, but I do think like we need smart founders to be working on the deployment part of the job.
Okay, so back to the beginning. You went to solar in India because you felt like that was the best place where you could apply your talent to something that mattered. And it was related to things that you had seen growing up with your parents as founders. Where do you draw your energy and your joy in your work today?
That's such a good existential question, Alfred. I mean, the first thing that you and I talked about it extensively, which is true, is like becoming a dad changes you. I think a lot about my girls and who I want to be for them and the type of world I want to create for them or help create for them. And so that is absolutely a motivator that wasn't there before. I have worked really hard, and you know this, to distance my sense of self from accomplishment.
How's it going?
It's a work in progress. I will say, like, being a dad and frankly getting older and doing more mentorship and less doing is actually really helpful there. There's a derivative of like, okay, I'm feeling proud of the impact I've had on someone else, but it's less like, look at the thing I did, mom, give me praise.
Yeah, it feels less self-serving. You're actually helping somebody do something.
Even though it is self-serving, because ultimately it makes me feel good about myself to feel useful to another person. And I think actually being a VC is largely that too. Like, I work with these founders. My job is to sit with you and try to give you whatever advice I can to slightly increase the chances of Crux being an iconic company. And if I get positive feedback from you, like, the best thing is, it's great when you tell me like, oh man, that was transformative. Here's how I changed my business as a result of that conversation. It's even better, obviously, when I see Crux go public. That gives me joy in a way that like is increased over time. It's like, I guess the way I'd think about it is like, I'm getting more derivative joy now from like trying to feel useful to other people.
Jake Saper, so great to have you here. Thanks for coming on Critical Capital.
Thanks, Fredo.
Jake Saper is a partner at Emergence. Critical Capital is co-produced by Crux and Latitude Media. Our production team includes John Sheehan, Jenna Herzog, Ann Bailey, Stephen Lacey, and Sean Marquand. Matthew Filler mixes the show. Additional production by Emily Hughes and the excellent team at Crux, the capital platform for the clean economy. You can find Critical Capital on Spotify, Apple, or wherever you get your podcasts. I'm Alfred Johnson. Thanks for listening.